one of my favorite podcasts called the All In Podcast, and there's a guy named David Sachs.
Yep.
And he's talking about multifamily real estate, specifically commercial real estate capital stacks being upside down because of rates. Can you dive into this and maybe more broadly talk about the significance of commercial real estate and how it may or may not affect just regular residential real estate?
Commercial all survives on debt. And debt survives on an interest rate. And so this gentleman's brilliant. I love the All In podcast. These guys are very entertaining. When Sachs said, hey, capital stacks are upside down, let's just talk about this in the plainest, simplest English possible. What he's saying there is he's saying interest rates have changed. Cap rates have changed. So this is affecting the loan to value of the property. What that means is it means people may have to sell the asset or they may have to do a cash in refi. Let's keep breaking this down so everyone's on the same page. Let's say you've got a $10 million building and it could be an office building, multifamily, whatever. And you have 20% equity and 80% debt. So you are at 80% loan to value. And that building was performing at a 4% cap rate. And it was, you had 3.5 or 4% commercial debt against it. Well, did commercial debt go up when the Fed raised interest rates?
Yes.
Same thing as the residential. It went up significantly. So commercial debt right now is also in that 7 to 8.5 range. So if you take a $10 million building and it was just at 3% and you had $8 million worth of debt at 3% and now it's 7, did your payment just shoot up huge?
Yeah, you're getting a drink.
Yeah, you're like, pour me another one. So what's happening is now the bank is saying, I want more collateral. Plus the cap rate changed. When the cap rate changes, it actually brings down the value of the building. That building may now be only worth $9 million instead of 10. And the bank now wants to see a 25% equity. Plus your cash flow just got annihilated because of the interest rate. So in that example, you would probably have to bring in somewhere between $1 million to $2 million to get that $10 million building back in line in a cash-in refinance if your note comes due. For those of you who don't play in the commercial space, you need to understand that commercial debt comes due on a cycle. Generally speaking, it's like every 5 years, but there is commercial debt that comes due 3, 5, 7, and 10. So it may be amortized over a longer run, but it always comes due. So commercial debt that's coming due in 2023 and 2024 is coming due at a 3% interest rate and lower cap rates because of the exuberance, and now it has to perform at a higher cap rate with a higher interest rate, which is generally going to require more cash. Now, the conservative operators, which were operating at maybe 65% loan to value or 70, they may be fine because maybe it just rose 10% and there's still enough equity there. So the thing you have to be careful of is you have to be careful of your own personal growth rate and greed. Yes, greed is a problem. You also have to be careful of if you're in a syndication or a REIT or a fund. What's the level, the LTV that they're going to carry on that? What's the amount of cash reserves they're going to carry on that? So we try to carry a little more cash reserves and we try to carry a little bit less aggressive loan to value. Why is that? Because it's not always going to go up in a straight line. My roommate from college called me and said, yeah, my parents are thinking about buying into this real estate syndication. I said, how long have they been a syndicator? He goes, I don't know. I said, well, if they've only won over the last 5 years when the market was shooting straight up like a rocket, don't do it. If they have a track record and they went through the last recession and they're still an operator today, you're probably safe. They're smart enough to be able to make it through. But this rising tide, this rocket shooting up of real estate made a lot of us look really, really smart, and we weren't smart. The market was just making us look good. Then what they did was they drained all the equity so they could pay out their investors or buy another property, whichever it may be. Well, now the piper is coming due in 23, and it's going to be due in 23, it's going to be due in 24, 25, but it's going to be worse in 3 and 4 because you're going to have the highest interest rates in 3 and 4. The last part of this discussion is anyone that is in a bridge debt. Bridge debt in commercial just means non-permanent debt. They could be doing a value add, they could be doing new construction, whatever it may be. It's non-permanent. All the bridge debt's the same problem. Is the bridge debt is in at a lower rate and now it's coming due and the pro forma was done at a 3% cap rate or a 4% cap rate, and now it's going to need to be a 5 or a 6. Commercial real estate is going to have massive problems. I think so. David Sachs in that episode, they asked him to pledge a whole bunch of stocks to essentially personally guarantee the bank's debt with his own assets. I wish I was able to do what he did. He just said, piss off wankers, and just paid the building off. We're not there yet, but not everyone's in that same situation. And it's starting now, this next 6 months to 2 years, there's going to be opportunity to pick up these assets in the commercial space that are going to come back to market, and they're going to come quick because the note is due and they can't do a cash-in refinance, so they're going to have to sell. So you need to be paying attention to this. This is another one of those opportunities. And, they're playing in the really big boy and big girl world where, you've got hedge funds and private equity and all that. The small to medium investor, though, it's going to be massive opportunity. There's nothing to say you couldn't go grab 5 of your homies and go buy a nice multifamily that's popping back to market. This is an opportunity that's going to happen, and you need to get in relationships with your banks. This is a cheat, this is a hack, whatever you want to call it. You need to call your local community bank. You need to find out who's in charge of special assets. That's their title. Hi Benji, my name's Anton. I know you're in charge of special assets. Do you guys have any non-performing assets on your portfolio or things that you think you're going to have to get rid of? By the way, my investors and I, we are no fuss, no muss. We've got our cash already lined up. We won't jerk you around. You tell me what the deal is. You tell me how long. I'll tell you during your timeline if we can buy it or not. We'll take it right off of your plate. Do you think that person wants to work super hard, or they just want to get the job done?
Just get the job done.
And then how bad do you think the bank wants their note to be performing?
They want it to perform.
They want it to
badly.
perform now. So what they're going to do is they're either going to extend and pretend, or the second this asset hits their books, they're going to immediately try to get it off their books. Banks are being pinched for their cash right now, because they're having to pay high interest on their savings accounts, on their money markets. The Federal Reserve is looking at them and stress testing them. So this is that, opportunity. Call your people in special assets, introduce them. Then you're going to start calling them on a regular basis. You're going to start sending them a letter on a regular basis, and you're going to build a relationship with these individuals.
That's an awesome hack. On that note, is commercial real estate's challenges going to affect residential, and how so if that's the case?
Commercial will affect residential if the Federal Reserve lets it get out of control. Understand the commercial market dwarfs the residential market. It's huge. So what they've done is they've lit the fire, and they're hoping it's a controlled burn. And they're sitting on the sides, digging around it, throwing a little more fuel over here. They got the water trucks over there, aka the money printer. And they're going, yeah, it's a controlled burn. It's not. It's burning out of control. And then you've got other factors like China, wars, things like that may affect that. If they let it get too out of control, absolutely it's going to affect the residential market. However, my personal belief, because you've heard it from me before, is the Fed is most likely done, if not done on the next one. They're just giving us their strong words. And so what's going to happen is that will start to buoy up this wildfire that started in commercial. Of course, with office being the worst part, and then some of these larger multifamilies being the kind of the second domino to fall there. But office is already getting really beat up.
Seems to me that an investor in residential real estate might want to consider multifamily because as inventory is super low, that's going to be in higher demand.
Yes.
Because not as much houses to buy, so they have to rent something.
I think the best way to think about this is if you are already an investor and you own a duplex, a fourplex, or maybe a couple single families, this is one of those opportunities for you to cycle up into the commercial assets. You should be looking at what you have, evaluating the portfolio, and then moving that up into the commercial debt. It's a great opportunity to do that.